Good morning. I want to welcome everyone participating in today's webinar, Strategies for PPP Loan Forgiveness. My name is Troy Turner, and I am a partner and director of tax at GRF CPAs Advisors, formerly Gelman, Rosenberg, and Friedman, and I will be today's moderator. I'd like to start off today with some quick housekeeping items and explain what you will need to do in order to earn CPE credit. Participants seeking CPE credit today must complete and submit a short evaluation survey that will appear automatically immediately following the webinar. You'll be asked to recall these words in order to receive credit. Please write down the CPE words when they are given and keep them until you receive your certificate. They will not be provided again. If you have any technical questions or issues during the webinar, please use the questions function to speak with our webinar administrator for assistance. The slide deck and recording from today's webinar will be available for download at the link shown here. You'll also receive a follow-up email with direct links. Technical support and CPE questions may be addressed to Nathan McElvin at nmckelvin@grfcpa.com. Today's learning objective is to provide practical guidance on PPP loan forgiveness, and 1.5 CPE credits are available for this webinar. I would like to introduce to you your presenters for today's webinar. Dick LaCastro is a partner and director of nonprofit tax here at GRF. Amy Boland is a partner in the audit department here. And Eleanor Litwack is a partner in our outsourced accounting and advisory services department. I will now turn over the presentation to Amy.
Good morning, and thank you, Troy, for the introductions. Thank you all for attending today. As most of you know, we at GRF created a COVID task force to try and keep on top of all the information relating to the CARES Act, especially the PPP. You may have talked to a few of us in the last few months. I know we spent a lot of time on phone calls trying to provide as much assistance as possible in these uncertain times. As you are well aware, the guidance on this seems to change constantly. Early on, there was something new all of the time with respect to the PPP application process and requirements. The FAQs were something we monitored and referred to daily. And now we've moved on to the PPP forgiveness side of things, and there's lots of questions, as suspected with the urgency that this was all implemented. I think I've said over and over again, that is a good question. We're waiting on more guidance in order to answer that question, and you may hear that again today. That being said, many of you are all in the same boat, and we hope to provide you with some helpful guidance today. Our agenda for today is as follows. We will start off by giving you an update on the PPP funding and current guidance. Then Eleanor will discuss guidance on forgiveness and the forgiveness application. And finally, Dick will discuss how this all relates to the Form 990 and discuss some potential future legislation. And as always, we've left some time at the end for questions. It is not any wonder that the PPP has caused so many questions. It is a huge program that was put together very quickly and pushed out to the organizations immediately in order to get funds in the hands of businesses as soon as possible. As of yesterday at 5 p.m., here are the current statistics. So approved loans as of yesterday were a little over 5.1 million in numbers. The approved dollars, as you can see, was over 522 billion. The average loan size is 101,782 with 5,461 participating lenders. As I've been preparing for this webinar, I've been monitoring the SBA website on this, and it's interesting to learn that actually the average loan size is dropping. And so I'm assuming that some of these smaller organizations are still applying here at the end. And as you can see, you still have 2 more days if you have not yet filed your application yet. You have until August 8th to get your final PPP applications in. And then obviously, as we will discuss later, there is potential for more funding in a potential second round. I wanted to start off by going over the Paycheck Protection Program Flexibility Act of 2020, which most of you have probably heard of. This was an amendment for the SBA and CARES Act to modify certain provisions. And some of the provisions that did change are, first of all, they extended the time in which you can use the funds. Originally, it was 8 weeks. They've now given you 24 weeks. If you received the loan prior to June 5th, which is the signing of the Flexibility Act, you have the choice of using either the 8 or the 24-week period. They also amended the 75-25 rule to 60-40. So what this means for you is now you can use 40% of those funds for non-payroll costs. You just have to meet that 60% payroll under the new requirements. Now, the non-payroll costs didn't change. It's still the rent, utilities, mortgages, etc. But it's just that now you can spend more of that if need be. They did also clarify that you cannot prepay mortgage on a covered mortgage obligation, prepaid principal on a covered mortgage obligation. And I think it's clear that within, especially with the first two bullet points here, that the federal government is trying to maximize forgiveness and hopefully allow for organizations to achieve 100% forgiveness. I think people were running into some issues in that short 8-week period and that 75% rule. And they realized that and basically allowed for some additional leeway on this to hopefully help the organizations in this time of need. In addition, under the Flexibility Act, they pushed back the deadline to rehire workers from June 30th to December 31st. They also eased the rehire requirements. Now, this didn't change the payroll calculation. You still have the caps, et cetera, the 100,000. But they did allow for some additional time and gave you some guidance on the rehire requirements, which I think Eleanor will go into more detail in a bit. In addition, they did extend the 2-year term to 5 years for those that were issued after June 5th. On prior loans, you can get the 5-year extension if you have a mutual agreement between the lender and the borrower. So I would suggest, if that is something that you're interested in, you contact your lender and get it in writing. I think what you'll really want to have is a formal written amendment to your promissory note that extends that to the 5-year period. In addition to this, they did an extension of the deferral period for the principal, interest, and fees, basically until the date on which the amount of forgiveness is determined. So what this means for you is that you have 6 months after the SBA makes the determination to make your first payment if you have a loan balance at that point. They did also add that if you fail to apply for forgiveness within 10 months, the recipient basically should start making payments that following day. So also just clarifying the term that you have to apply for forgiveness. So now, once you've made it through the application process, you've documented why you feel the PPP funding was necessary, the uncertainty. I know we had lots of discussions over the certifications that were made and just documenting that for your records. But now you have it, the cash comes in the door. How should you record this? So the AICPA came out with 2 options. The first option is to record it as a financial liability under ASC Topic 470. And this method would be recording a loan payable on your books. It's really the method I think that we at GRF have decided is preferred and is appropriate with your promissory note. It ultimately, takes that cash, records it as a loan, and then because you do have a loan, you should then record your accrued interest. So basically go through that calculation, determine that accrued interest at that 1% rate. There could be chances where it's not material, so you may end up not even booking the whole amount, but I think as you will want to do is make that calculation and determine if it is in fact material, and then you can also present it to your auditors when they come and have the discussion that you looked for that liability, and if it is material, then you're going to book that interest liability as well. That loan payable will continue on your books until it is either partially or wholly forgiven. So ultimately, that's when you receive notification from the lender and from SBA that it has been forgiven, or you pay off the loan. So continue with that loan payable recorded until that point. When you do determine if it's either partially or wholly forgiven, or get notification from SBA, basically that amount then becomes a gain on extinguishment. So in order to record this, this is basically revenue that would be considered an other item on your statement of activities. And ultimately, that is when the revenue would be booked, is when you get that formal approval for that it has in fact been forgiven. The other option is depending on if a non-for-profit concludes that it is a grant and it is expected to be forgiven. So ultimately what this says is it's a conditional contribution under topic 958. This is obviously the other option that the AICPA has presented. So if you determine that it's a conditional award, when you get that cash in your bank account, you would book it as a refundable advance. Under topic 958, they went into some detail, obviously, about the two components of a conditional contribution, which is right of return and barrier. And I think in this case, the barrier is one that is really more relevant in determining for the award. And I think as I laid out here, you can see there are three barriers that come to mind. The first one is incurring qualifying expenses. I think you can pretty easily determine when that barrier is met. You are tracking the payroll, the rent, utilities, et cetera, making sure that you are in compliance with the 60-40 rule. And you can pretty much say, yes, we have met that, we've recorded this, we've met the barrier, and then move on to the next one, which is the FTE reduction and the 25% wage reduction. Again, here, I think you can easily measure this. This is something you're going to be tracking, something you're going to need in the loan forgiveness application. So I think you can determine from your internal record keeping if you meet this barrier or you satisfy this condition. The third one I think is a little more questionable, and where the questions come in of when you record this or when you recognize revenue on it. And that's the review and approval for forgiveness. What you have to determine is if you believe that this is an administrative function or truly a barrier until you receive that notification of forgiveness. Ultimately, it ends up being a judgment by the non-for-profit organization. If you conclude that it is administrative, you would continue on with how you've booked your refundable advance and you would recognize revenue accordingly. If you feel it's more of a barrier, then it would basically sit there really more in your refundable advance until you meet that last condition and can satisfy that. This, I think, is definitely one that uses more judgment for an organization. And in this case, I think that you're going to want to make sure that you document why you believe that it is a conditional grant, why you believe you've met the barriers, and how you are recognizing revenue and that your records are appropriately kept. I do think that every organization will have to analyze this and come up with that methodology. And as the auditor coming in, I would really want to see the documentation surrounding that. However, there is cases where I think that organizations may look at this option. You may have loan covenants, and if you go the loan route, that could potentially take you out of compliance with debt ratios, et cetera. But I also think that it is something that if that is the case, you may want to check with your bank and see if you can get a waiver for that. Ultimately, though, I think, as we said, you have the two options. But I think as you move forward and are looking at this, I think that we get these questions a lot. So I wanted to give you a couple tips and other answers to some questions that we see a lot. And the first one, I think, is really which way should we go? And I think we've determined, as I said, that we feel the loan is the most conservative approach. You have a promissory note, you need to wait until you receive that forgiveness. So that is really what we're recommending on that. The other thing is there's a risk here that there is a prior period adjustment if you accidentally record revenue because you feel it's going to be forgiven. And Nathan, can you advance the slide? Thank you. So ultimately, this is one of the areas where we think could cause more risk for the organization. Nobody wants to actually recognize revenue, end your fiscal year, then come to find out that it's not all forgiven and realize that you have revenue recorded on your books that now we have to do a prior period adjustment for and take that revenue back off. So again, I think the conservative approach would be the first approach. And because there's still so much uncertainty, I think that also leans more towards that approach and determining what the actual forgiveness piece will be. Even though there were FAQs issued 2 days ago on the forgiveness piece, I think there's still many questions surrounding this. So I think it's just still, best practice to go that route. And the one thing I wanted to just touch on, because it comes up a lot, is that double dipping is not allowed. This is a question we have received many times, and the OMB had really clarified this in their letter, the M2026, where they specifically said, you cannot charge a federal award for the same salaries that you may be applying to your PPP. And we receive this question with non-federal sources as well. And I do think that the answer is still the same. I think that, when you look at it, you don't want to charge a funder for salaries that have already been reimbursed somewhere else. So that is something to keep in mind when you're looking at all the calculations for the forgiveness piece and determining which route you want to go as a loan or as a conditional grant. And then finally, just some more tips and reminders that I wanted to touch on was the lender has 60 days to issue a decision, and the SBA has an additional 90 days. So we could be looking at 5 months before we know ultimately if our PPP funding has been forgiven or not. And I think this is very important for many organizations, but I think there's more of an advantage for those who have the 9/30 and the 12/31 year ends, because we have more time to sort of see how everything is going to play out and have time to decide exactly how we want to treat these in our financial statements. I think it's more crucial at June 30th because you are obviously already past your year end, and decisions need to be made quicker than waiting a long time if you need to issue financial statements. However, both AICPA and the Journal of Accountancy have both issued articles about do not rush to file. We do feel that there is still more guidance coming. The situation right now is too dynamic, and we want to make sure that you are achieving the most you can achieve. And in theory, as we talk later, there may be some instances where some of these may have even a blanket forgiveness, so you may not have to do as much work as you originally thought. So I think right now, the best advice is to just continue to monitor the situation and then determine, when the best time to file is, hopefully after we've received continuing information. And I think that goes especially true for those with federal funding, because there's still many questions out there in the federal realm. And even though I know that they have sent a letter asking questions, especially around indirect rate costs and things like that, there still hasn't been additional guidance on how that should be treated. So I think that's another reason to sort of sit back and wait a little bit before we rush to file. We still have time to do that. One thing I will note, though, is regardless of treatment, disclosures will be important. You're going to have to tell your story. And I think that, that comes up a lot too as a question, because organizations may be showing these expenses, paying their salaries, paying the rent, et cetera, but there may not be the revenue to cover it, especially when you record it as a loan. So you may be showing deficits for the year, but I think that you can explain that in your footnote disclosures to your financial statements, saying, that you do expect forgiveness, that you do expect to book revenue, in the subsequent year that will cover some of those deficits. So I think either, regardless of treatment, the disclosures are going to be very important for the readers of your financial statements. It may even be that you get or you obtain that forgiveness certificate from the lender and from SBA, and that may be something that we could report as a subsequent event in your financial statements to make sure that that is appropriately addressed. And that's really sort of the beginning pieces of just some of the tips and recommendations on the PPP funding. I will turn it over to Troy now for our first polling question.
Thank you, Amy. Yes, we reached our first polling question, and that is, as a result of the PPP Flexibility Act, have you opted for an 8-week or 24-week forgiveness period? So if selection A is 8 weeks, selection B 24 weeks, and C is unsure. So please take a moment and answer the polling question. While participants are submitting their answers, I'll provide the first CPE word. The first CPE word is deferral. If you want to receive CPE credit, please jot these words down because you will need them for the survey following the webinar. Again, the first CPE word is deferral, D-E-F-E-R-R-A-L. And now we'll just take a moment to get the results and let Amy comment on those.
So it looks like here that 59% of you are on the 24-week period, 30% are unsure. So I think that ultimately, you know, and we have that 12% at the 8-week period. What I'm seeing is a lot of people are extending to that 24-week period just because they have, they can use the funds more wisely with that 2.5 times payroll. They weren't quite getting to that full forgiveness in that first 8-week period. So I think they are taking advantage of that 24-week period, and that makes sense. And I think now we'll turn it over to Eleanor.
Yeah, so in this section, we wanted to dive in a little deeper into the actual application process and the fields on the application. Next slide, please. So we're still waiting for another round of guidance, which is why the application portals aren't live yet. So no banks are accepting applications at this time. If they are, if you have a smaller bank who's asked you to submit paperwork, they're not submitting it to the SBA yet. And in fact, when the additional guidance comes out, the application itself might be amended. So we're not expecting a drastic change on those, but there still might be certain fields that are added or edited based on the next round of guidance that comes out. So at this point, as Amy suggested, you want to continue to project, continue to budget, monitor what you're spending everything on, but there's no rush to submit. And when those portals do open, it's not going to be a mad dash to secure funding. You already have the funds. They're already backed by the PPP funding amounts. It's just a matter of getting the paperwork into place, and we don't expect it to be a rush. That being said, many organizations that did opt to use the 24-week period in order to maximize forgiveness are seeing that they're going to spend the funds a lot sooner than 24 weeks. And we did get confirmation that they'll be able to apply within that covered period as long as they meet certain basic requirements. So in certain cases for simple loans, if you didn't reduce your FTEs and you didn't cut salaries and you used your funds, say week 15, and the portals are open, you will be able to apply at that time so that you don't have to wait for the 24 weeks. It gives you peace of mind, gets it off your desk. And then just going back to some of the basics, Amy spoke about the 60-40 rule, but this is a question we're seeing a lot. Can I only spend 60% of the loan on payroll? And that's not the case. You could spend 100% of the loan on payroll. The rule here is that you can't spend more than 40% of the loan on the non-payroll costs. So you want to aim for anywhere from 60 to 100% on the payroll and benefits, and then anywhere from 0 if you don't need it, or up to 40% on the non-payroll costs. So the rent, the utilities, the mortgage interest, and those line items. And then the other key to maximizing forgiveness is the FTE and wage level items. With wages, so long as you don't cut individual employee salaries for those earning under 100,000, if you don't cut them by 25% or more, then you're safe in terms of wage level reductions. And then with FTEs, you want to maintain your headcount. There are numerous safe harbor reasons that were released that I'll go over in a moment here, where headcount reductions are acceptable and won't reduce your loan forgiveness. But if you're maintaining your salary levels and your FTEs, then you're probably going to get full forgiveness if you meet some other factors. And just want to point out that the salary level issue is on an individual employee level. So you'll see in the full application that individual employees are listed and their salaries are examined, whereas the full-time equivalent requirements are for the organization as a whole. So in theory, if you let go of a CFO and a CEO and you hire 2 full-time interns, that covers the FTE requirement. You're back to where you started and you're fine. So the FTEs are looked at as a whole, and the salary levels are looked at the individual employee level. So these reasons were released a couple weeks ago when we first had guidance that indicated that loan forgiveness could get reduced by reductions in FTEs. There was a little bit of a scare because a lot of situations came up where FTEs were reduced because of non-COVID reasons. So these exceptions were kind of a relief. And over here, they're at the individual employee level. In a moment, we'll get to blanket exceptions. But those reasons here, the ones listed, they're not going to cause a reduction in your loan amount if your reasoning falls into any of these categories. So the first one is if you laid somebody off when the pandemic started, but then you offered to rehire them or bring back their hours that you cut and the employee rejected the offer, then you're safe, but you need it in writing. If you terminated employees for cause or they resigned, or we've seen a lot of cases where employees voluntarily requested to go from full-time to part-time, which is an FTE reduction. But if they requested it, then that does not impact your loan forgiveness. And then finally, if you laid somebody off and then tried to hire someone with similar qualifications for that employee level, and you didn't find anyone, as long as you have it in writing, this counts as an exception. So in all cases here, you're going to need documentation. You'll see later that you don't actually need to submit the documentation with the application, but you absolutely need to have it on file in case your paperwork gets examined later on. And I'm sure there are some lenders that might actually ask for this up front. And then we have some blanket exceptions where, regardless of the individual reasons that employee count went up or down, if you fall into one of these two, then you're safe on the whole. So the first one is operating restrictions. If a borrower was unable to operate at the same level of business activity because of compliances with one of these federal agencies, so Health and Human Services, CDC or OSHA, for COVID reasons, then they don't get, their loan doesn't get reduced for that reduction in headcount when they weren't able to operate physically. And the guidance does mention direct or indirect. So there are many non-essential businesses like hair salons, restaurants that were shut down technically by the town or state government. That's considered in most cases an indirect shutdown by the government bodies, the HHS, the CDC, or the OSHA. So you would qualify for this if you can check off this box. Again, you're going to need documentation. So you want to save whether it was an email you received or general guidance from your governor, anything you could screenshot and save on file to show that you were unable to operate at the same level because of safety requirements will allow you to fall under this exception. And then the second one is for the organizations that actually restored their FTEs. As Amy mentioned, in the PPP Flexibility Act, they striked the June 30th date and replaced it with December 31st. So we now have until the end of the calendar year to bring back our FTEs to what they were at February 15th, 2020, in order to protect the loan and not get forgiveness reduced because of that reduction in full-time equivalents.
Okay, thank you, Eleanor. We've now reached our second polling question. Do you qualify for the easy application? A, yes, B, no, and C, if you're unsure if you do. Please take a moment now to answer that question. While participants are submitting their answers, I'll provide the second CPE word. The second CPE word is exception. If you want to receive CPE credit, please jot these words down because you'll need them for the survey following the webinar. Again, the second CPE word is exception, EXCEPTION, exception. So we'll take another moment here to get those results, and then Eleanor will comment on them.
So Troy, this was actually a trick question because we're about to cover how to qualify for the easy application. So if you're the 56% that's unsure, maybe we'll clarify it now. But it looks like some folks do already know that they qualify for that easy version, and then 22% have to fill out the full application. So in terms of qualifying for that, and these three reasons that they came up with, the three things that make you qualify for the easy application, they're right there on the face of it. So in the slide deck, you'll see a hyperlink to the easy forgiveness application, and these are spelled out in more detail. And if you could check off one of these boxes, your application process for forgiveness will be a lot simpler. And the easy application does not mean you qualify for full forgiveness. It doesn't mean you have a small loan. It just means you have more of a simple loan. So the way that they boxed these things are: one, you're self-employed, you're a sole proprietor, you don't have employees, great, you could file the easy application. There's no need to go the drawn out process of calculating everything else when it doesn't apply to you. The second group of reasons here is for organizations that did not cut salaries by 25% for those under 100K employees, and they didn't reduce their FTEs. That simplifies the process, simplifies the paperwork. You could qualify for the easy application. And then the third reason here is, again, you didn't cut anyone's salaries by more than 25%, and you were unable to operate at the same level of activity due to those three federal authorities, the CDC, OSHA, or HHS. So if you could check one of these boxes, you qualify for the easy application, and your life will be simpler when it comes to submitting this thing. And the application is really, the main part of it is a one-pager, and this is the top section here. It's screenshotted here, and then you have a hyperlink at the bottom if you get the slide deck and you want to look at the whole thing. The top section is just basic information. So you have your SBA loan amount and loan number. On the second row under that main section, it asks for the PPP loan amount and loan disbursement date. That disbursement date is going to indicate the beginning of your covered period, unless you chose the alternative covered period. But in most cases, the date where you received the funds will be the beginning of your 8 or 24-week period. And then in the row before that, the row after that, the third row there, it's asking for your employees at the time of your application and the employees at the time of your forgiveness application. Just take note that these boxes here are not the indicators of the FTE reductions. You'll see that later on in a more detailed section. We're just assuming that these boxes are here probably more for the SBA and the banks to gather the data on the workforce that they're protecting, and it's just an easy way for them to assess like overall in general the metrics, but this is not the indication of your FTE reductions. And then on the fourth row below that, it asks for the EIDL advance amount. This is the only place on the application that you're going to put it. So if you did receive that EIDL grant, $10,000 or less, it's going to reduce your forgiveness amount, but don't factor it into the calculations later on. So what the SBA is going to do, they're going to take that forgiveness amount from your actual calculation section, and then they're going to look at this box. And let's say your forgiveness amount is $300,000 and this box says $10,000 in it, they will reduce that $300,000 by whatever's in this box, as long as it ties to their records as well. And then last year, I just want to point out that bottom checkbox, if you have a loan in excess of 2 million. So even the larger loans could qualify for the easy forgiveness application. But if you are in that high loan category that is subject to audit, you check this box off, make yourself known, and this is where they will be looking at whether you needed the loan in the first place, the paperwork and the backup that you used to apply for the loan, and what you spent the loan on. So that's this checkbox here at the bottom. And then the bottom section of the page is the very basic forgiveness amount calculation. So this is the easy version. In this example here, the organization accumulated payroll and benefit costs of $300,000. Line 2 just asks for that business mortgage interest. Over here it's 0. And then the organization in this sample had a big lease, so their rental amount, their rent payments were $280,000, their utilities were $20,000, and that brings you to the total on line 5 of $600,000. So in this specific sample, the full loan of $600,000 was spent. Line 6 is the PPP loan amount. The organization spent it all on qualifying costs. However, they did not meet the 60% requirement because they only spent 50% of the loan on payroll costs. So this is a quick sample here to show you that even though you're filling out the EZ application, you still might not qualify for full forgiveness. So that's what line 7 is doing. It's running that test to see, okay, great, you've spent the entire loan, but did you spend at least 60% of it on payroll? And if not, then you take the lower of lines 5, 6, or 7, and line 8 becomes your forgiveness amount. And line 8 is what they're going to look at and then compare it to the idle advance just in case that needs to be reduced further. And we covered the qualifying payroll costs in depth in one of our webinars a few weeks ago, most of which is still relevant, but just want to walk them through here again. So what can you include in payroll costs? The boxes and the qualifications that are labeled payroll costs throughout the application refer to payroll and benefits. So included in this line is your US employee salaries, up to the equivalent of $100,000 per person. So if you're using the 24-week period, the maximum individual wages you can claim as a PPP cost for each employee is $46,153. However, if you're using the 24-week period, applying early for forgiveness, that means you're essentially using, say, a 15 or 16-week period. You're going to want to prorate that $100,000 to figure out the maximum that you're allowed based on your shortened period. So you just want to make sure, based on the number of pay periods you're including, to only include the equivalent of up to $100,000 in base pay, plus bonuses and everything else, cash compensation per employee. And then the second main point, which was also just clarified this week with some FAQs that were released 2 days ago, wages include those that are paid or incurred during the covered period. Again, if they were paid during the covered period or incurred during the covered period, you could use the PPP loan on them. So if you have any paycheck date that falls in the covered period, regardless of what timesheet dates it covers, if you paid those paychecks during your covered period, that is considered PPP loan forgivable. And this applies mostly to the beginning of everybody's covered period, where they received the loan, say, on May 10th, and they had a payroll run on, say, May 15th. That entire May 15th payroll could be included as the PPP cost because it was paid during the covered period. And on the flip side, you might have wages that were incurred during the covered period, but the payroll comes a little later. So say you went with the 8-week period, and you had a pay date that fell a little bit after that, the end of your covered period, but timesheet dates within the covered period, you could include those timesheet dates in your PPP loan costs because the wages were earned, they were incurred during the covered period. So that's an important point to make there. And then you actually don't include the employer portion of federal taxes. So you have wages, but not FICA. You leave those out of your PPP cost calculation. But on the next slide here, you'll see that SUTA actually is included. So your employer taxes for state unemployment, those are forgivable loan costs. The other thing to exclude is your FFCRA wages. So if you have employees that fell under the Relief Act that allowed the federal government to pay for time off for employees that were taking leave for those very specific COVID reasons, we call those FFCRA wages, you cannot double dip. If the federal government reimbursed you for those employees' time off, you're going to exclude that portion of their wages from all of your payroll costs throughout the PPP application. So there's no box for it on the application to sort of take out the FFCRA wages. So you're going to want to do that on the back end when you're calculating individual payments amount and what you paid everybody. Don't include any of their wages that were already reimbursed under the previous COVID relief acts. Bonuses, severance, hazard pay, other cash compensation, that's all okay. For those earning under 100,000, yes, you could bonus them out and include that as a PPP forgivable loan cost. That is okay. And then the last piece of the payroll costs that are eligible for loan forgiveness are the benefits. So primarily it's group health coverage and retirement contributions, but only the employer portions. So in most cases, you'll have, say, a health insurance invoice where much of it is deducted for employee paychecks. You don't want to include those deducted amounts. You can only include the employer side of those payments, and the same goes for retirement.
Thank you, Eleanor. All right, we reached our third polling question. Is your payroll service providing you with PPP forgiveness reports? Again, simple answers here: A, yes; B, no; and C, unsure. Please take a moment now to answer. While participants are submitting their answers, I'll provide the third CPE word. The third CPE word is salary. If you want to receive CPE credit, please jot these words down because you'll need them for the survey following the webinar. Again, the third CPE word is salary, S-A-L-A-R-Y, salary. So while we wait for those results to come in, and then Eleanor will comment. There we go.
Sure. So anyone using a medium or big payroll company will surely have canned PPP forgiveness reports where the payroll company gives you the employee wages, factors in the $100,000 limit. Hopefully the reports are sophisticated enough where you could put in your covered period and those calculations can be done for you. It should also give you the information in a format that feeds into Schedule A, which we'll walk through in a second, where you actually, if you're filling out the full application, you need to list your employees and the last 4 digits of their social security number. So hopefully a lot of that could come from your payroll company. And it looks like over half of you already have established that, so that's great. So onto the full forgiveness application. If you didn't qualify for that EZ, this is the bottom section of that same main page. The top section where we filled out general information about the PPP disbursement date, the EIDL advance, your business information, that's all the same. And then the bottom of this page is screenshotted here. And again, there's a hyperlink at the bottom so you could see the full thing. It's hard to fill it all into one slide, but you could go take a look. And the full forgiveness application, it has the main page and then it has 2 schedules that are attached to it, Schedule A and then a Schedule A worksheet. So at the bottom section here, it's similar to the EZ one, except it's more detailed in terms of what happened with your FTEs and your salary and wage reductions. So you start with your payroll costs at the top, and because those are not as straightforward as the organizations that didn't have reductions, it feeds in from Schedule A. So there's a more drawn out calculation, and then you bring that onto the summary page here. And then your 3 other types of payments: mortgage interest, rent, utilities. In the middle section there, you have your adjustments for the full-time equivalent and hourly wage reductions. There's a detailed listing of employees and what their wage reductions were on Schedule A, and that goes on to line 5 here. where that it'll start by reducing the forgiven amount by putting it in here. Line 7 is the FTE reduction quotient. So this line here could be no greater than 1, and a 1 here is optimal. So if you could put a 1 in this box, which you'll calculate on another worksheet, that means that 100% of the loan is forgivable just based on the FTE test alone. Anything less than 1 here indicates that your loan forgiveness is going to be reduced, whether it's 0.8, 0.7, based on your FTE reduction that was calculated in depth on another worksheet. So that's what they're referring to with the FTE reduction quotient. And then you get to your potential forgiveness amounts. So line 8 is the line 6 multiplied by the FTE reduction quotient to see what that comes out to, your loan amount. And then again on line 10 is your 60-40 test. Did you spend at least 60% of the loan on payroll? If not, you have a further reduction to forgiveness. And the Schedule A worksheet, some of you probably have seen this already if you were already working on your FTE and salary calculations, but it has a whole detailed listing of employees by name and by last 4 digits of Social Security number. It goes through each of their compensation and what their average FTE was. So it's a 1 for full-time employees. There's a simplified method of part-timers where you're allowed to put 0.5 and that's throughout the whole application. So you can, rather than calculating the full-time equivalent for your part-timers that have varying hours, you could use 0.5 for anyone that's part-time and 1 for anyone that's full-time in your FTE calculations. And the section for employee listing on the actual application is about, I think it's 6 or 7 lines. So many places will have to attach worksheets to expand on that and give the full listing. And then on the same Schedule A worksheet, you have this initial FTE reduction safe harbor test. So this is more of a simplified method to just give a snapshot if you had a reduction of FTEs as compared to pre-pandemic times, which over here is at February 15th. That's the date that keeps coming up. And during the period February through April 26, 2020. So it's just like a quick way to see if you qualify just based on this test, if you're able to put a 1 into that FTE reduction quotient box that we just saw in the previous slide. So step 1 here, you enter your average FTEs between February and April, which is a pandemic time period. And in step 2, you do that same thing, but you enter it for February 15th, 2020, which is that pre-pandemic time. So if you could show that you did not have a reduction between those 2 periods, you're already good, and you could skip to step 5 and enter a 1 on the application to give you full forgiveness based just on FTEs alone. If you still didn't meet that test, you can go on to step 4 here. And indicate whether you restored your FTEs. So you dropped your headcount between February and April. So you're showing that it went down as compared to February 15th, but you hired people back, you brought them back on staff, and now you've met that test by December 31st, 2020, which is the restore date. You could check off step 4, and then you could enter a 1 to get that full maximum forgiveness based on FTEs alone. So that's what this little test is doing here. And it's probably easier than doing the full FTE analysis and looking at those look back periods. So that's what this worksheet here is for. And you could see that they're trying to make this very borrower friendly. There's no need for extra work if you don't have to do it, but many of you will. So that's actually on Schedule A, which is the next slide. So on Schedule A, you have data that's feeding in from the worksheet that we just looked at, which is a little lengthier than what we put on the slide. But you have fields for your salary and benefit data, all the wage information that you calculated based on the individual employee listing, and then again, an FTE reduction calculation. So over here, this is where it asks you about those reasons that we said were an exception. If you satisfy any of the criteria here, you could check off these boxes and enter a 1 on that main page for getting maximum forgiveness based on the FTEs. So the boxes here are on the second row. There are no reduction in employees or average hours. So you're certifying that you actually didn't reduce anybody's hours or lay people off. You could check that box off and you're good. Or you can move on to the next one, indicating that you were unable to operate due to the OSHA, CDC, HHS situation. You could check that box off and you're good. Or you move to the bottom, and this is where the more lengthy test comes in. So if you satisfy the FTE Reduction Safe Harbor 2, which is what we saw on the worksheet, you could check the box here, and you don't need to go through the lengthy calculation. If you don't, you go to line 11, and then you enter your FTEs for that look back period, which is February 15th, 2019 through June 30th, 2019, or January through February 2020. So those are the two choices for reference periods to determine whether you either maintained your FTEs at those level or you brought them back to those levels. So those are your two reference periods, and this is where you enter on line 11, the lower of the two. So this is your sort of your FTE target that you want to meet. And then again, it brings you to the bottom, the FTE reduction quotient, which we want to be a 1. Assuming the above criteria are met, that will give you optimal forgiveness. One thing that they came out with when the applications were released are the specific documentation requirements. And these are located in detail in the instructions to the application, and we've summarized them here. So there's a good group of things that need to be submitted along with the application. And then there's another group of things on the next slide, which you'll keep on file, you're required to keep on file, but you don't actually need to submit with the application. Now, every bank might have a little bit of a different process here, and some might ask you for items that are not on this list or items that are on the optional list. But in terms of what the SBA is requiring and what will likely be the standard throughout, this is the listing here. So what goes along with your forgiveness application are your individual payroll reports. So you have to support the individual wages that you use the PPP loan on, your quarterly state and federal tax filings. We've actually gotten many questions on this one because they don't exactly line up with the covered period. These are quarterly and your covered period crosses quarters. That's fine and it's expected. I don't think they're going to try to tie it to anything because it'll be nearly impossible for a few reasons, but they want it on file. So you're going to submit the 941s and the state unemployment filings that fell somewhere within or around the covered period. Then you're going to need the payment backup for your other costs that you included, your health, your retirement, your utilities, your rent, and verification that lease agreements and other like phone utilities and other things that you claimed on the PPP loan existed prior to February 15th. So you can't move into a new office in March and then use the PPP loan on that. It has to be something that was in place prior to that February 15th pre-pandemic time. And then for the full application, the SBA is going to require FTE documentation for the chosen look back period. So if you did have to use the look back period of that short time in 2019, February through June, or the January, February 2020 time period to show that your FTEs were maintained, they're going to want to see that as part of the application. And then in the instructions also are listing things that you have to keep on file for 6 years, and that's 6 years from when the loan is forgiven or you pay it back. So you don't actually have to submit these things, but they're subject to examination. You're required to keep them on file. And it's a little bit lengthier for the full application, but in general, it's everything that's sort of the background support for everything you put on Schedule A, the Schedule A worksheet. So if you did have a reduction in wages or you did not have a reduction in wages, all of that has to be kept on file to document and show that that was the case. If you did qualify for the EZ, whichever one of those 3 boxes you check to show that you qualified, you're going to have to keep support to show that that was the case and certify that you did actually qualify for the reduced condensed application. Anything supporting the exceptions to your FTE reductions. So if you gave offer letters to employees that you laid off, keep those. If they wrote back, whether by email or a formal letter, that they're declining the offer, you want to have all of that on file. If you terminated someone for cause and that caused an FTE reduction, keep that in your PPP files along with your HR files as well. And then if you are claiming that you couldn't physically operate because of the government restrictions, you're going to need something to show that that was the case. And then it goes back also to the original loan documents that you used to get the loan initially. So all those calculations that went into those applications, the necessity for the loan, and any other loan related records. All of that's going to need to be on file for 6 years.
Thank you, Eleanor. All right, we reached our 4th and final polling question of the day. Are you expecting full forgiveness on your loan? A, yes, B, no, and C, unsure. So please take a moment to answer that question. While participants are submitting their answers, I'll provide the final CPE word. The final CPE word is donor. If you want to receive CPE credit, please jot these words down because you'll need them for the survey following the webinar. Again, the final CPE word is donor, D-O-N-O-R, donor. So we'll wait a second for the results to come in and Eleanor to comment on them.
Yeah, you could see that the 24-week period and the other regulations that came out were really in the favor of borrowers. We have 69% of you that are already expecting full forgiveness, 10% that know you're not going to get full forgiveness based on probably one of the FTE or wage reductions or those other qualifying things, and then 21% that are still unsure, which is normal. You have time still. And now we turn it over to Dick for the 990 disclosures.
Thank you, Eleanor, Troy, and Amy. And as always, we always look at the financial statement impact, as Amy talked about. And now we're going to talk a little bit about, after that, we're going to talk about how the impact may be on your 990. And this could be particularly important for some organizations whose public support percentage, may be hovering near the 33 1/3, or the threshold where they want to be able to predict what the impact would be from the financial statement treatment. Because as you see up here, generally our Form 990 presentation will follow financial statement presentation. And I just want to recap a little bit about what Amy had said based on the 2 options that the AICPA has laid out. So the first one is, if the loan is treated as a conditional contribution, as that contribution revenue is recognized for financial statement purposes, we would report it on Part 8, the revenue part of 990, on line 1. And again, depending on how it's recognized and the conditions being met, it is possible for some organizations that some of it could straddle, the recognition could straddle financial state or for your fiscal year. Schedule A, if you report it on Part 8 as a contribution, then Schedule A, the public support test, treatment would again follow the recognition timing of that contribution. If it's a contribution, conditional contribution, no interest would be accrued, so we wouldn't have an expense there, which would obviously be part of your functional expense on Part 9. Now, if it's treated as a loan, obviously the liability the liability will be reported on Part 10, the balance sheet, until it's forgiven. And I know we get a lot of questions about, what's the timing of that and how's that's going to look if the funds are received in 1 year and the loan is ultimately forgiven subsequently. But if it is a loan, we would have interest expense accrued, which would presumably, if it's material, and then we would have as an expense on Part 9. Forgiveness when it is, and this is an important part, if it's treated as a loan, the AICPA guidance as we currently have it is the gain, it would be treated as a gain on extinguishment for financial statement purposes. And that's going to be a little bit interesting there. So we have a couple of questions that come up, as we'll see on the next slide, when we talk about the impact on the public support test. So if it is recognized as a contribution, and I've had these conversations with my colleagues around the country, as I'm a member of the AICPA Technical Resource Panel, and we've had these conversations, who is the donor? Because the money is technically, your agreement is coming, is with the bank. Your promissory note's with the bank, but the SBA, a government agency, is basically the one that is the source of the funds. And that could be really important when we treat it as a contribution, because government money is, government contributions are not subject to the 2% limit for your public support test. However, the bank, which is, again, presumably a for-profit corporation or other entity, would be subject to the 2% limit. So, you know, my personal feeling is that I think it would be treated as kind of a pass-through from the banks, from the SBA through the banks, because the banks are really administering this, and the SBA is the source of the funds. But again, we don't have any guidance on that yet. But that seems to be, I think, where the thinking is on that. If it's initially treated as a loan, you know, how is the gain on extinguishment reported? Is it reported as a contribution? And then you get to the question that we mentioned above. Okay, if it's forgiven by the bank, because that's who your promissory note is that going to be subject to the 2% limit, which could again impact negatively your public support percentage, or is it going to be the government? So the gain on extinguishment, you know, is it treated as other income? A lot of times when we have two related organizations and one owes the other money and they forgive it, we would say, well, that's really a contribution because we owed it to them. If it's treated as other income, that would have a detrimental impact on your public support test, typically because it goes into the denominator on the public support test, but doesn't go into the numerator because it's not a contribution or program service revenue. So in that case, depending on which test you fill out, in that case, if it goes into the denominator and could be a big number, that is something that could negatively impact your public support test as well. Would it be an other change in net assets, which would not go into the public support test calculation, and it'll probably be shown on the financial statements as a separate item, but how do we treat it for 990 purposes? Again, we've asked the IRS for some guidance on that. We haven't received anything yet, and we'll continue to monitor that. Obviously, the impact of a government contribution will almost universally help your public support percentage. It may not matter for some organizations, but will matter for others. And as I mentioned, the other income increases the denominator. So just that when you're looking at the options for how we're going to treat this for our financial statement purposes, I think it's also incumbent on organizations to understand under these different options or different possibilities, if you will, how that impact and if it will have a significant impact on your public support test, and make that determination, I think, in coordination with your accounting firm. So that's a really important thing, not to leave till after the financial statements, but to evaluate up front. So the next thing we're going to talk about, and this stuff it's always fun because things are in flux. We don't have an agreement yet. What I've put up here with some bullet points are what they'll call PPP2 portion of the HEALS Act, HEALS, which is a follow-up from the CARES Act, The House version is called, I believe, the HERO Act. So what they did is they put a number of bills together under the HEALS Act, and the Continuing Small Business Recovery and Paycheck Protection Program Act is part of that. And again, this is as it stands, as of last week or thereabouts, and we don't have an agreement, and there's a deadline set for Friday. We're not sure if we're going to get anything, but here's what the Republican version does, and I'll mention a little bit about the House bill, which was passed quite a while ago, and what that may do to it. But there's a couple of significant things. The first one is allowing additional allowable and forgivable expenses, including software, cloud computing, HR, and accounting needs, which is interesting. I think everybody recognizes the fact that Zoom and other costs or even cloud computing costs are maybe more significant now than they had been in the past. And so they want to cover those. Property damage costs to public disturbances, not covered by insurance. Covered supplier costs, which is covered supplier costs are for goods pursuant to a contract in effect before February 5th that are essential to the operation of the organization, and PPP and other adaptive investments to comply with federal and health and safety guidelines from the period March to December 2020. It also clarifies that group insurance benefits are included in payroll costs. So what and I'll go through this, and then I'll mention a few things about what the Democrat proposal, at least what's on the table currently, would do. There's a simplified application process for loans under 150, and then between 150 and 2 million on there. And as we move to the really important part, there's a couple of really important parts of this on the next slide as it relates to the Paycheck Protection Program second draw loans, or I've seen it PPP2. So if we go to the next slide here. Some important things, and again, none of this is set in stone, and some of these provisions may not get adopted, and some may get tweaked here, but eligible businesses with 300 or fewer employees that demonstrate at least a 50% reduction in gross receipts in the first or second quarter of 2020 relative to the same quarter of 2019. I think the way it's currently written, you would have that either or situation. A couple of things to think about. There's still, at least based on my experience and some emails and questions that I've fielded, I think on the Hill, they're still looking at whether or not that 50% reduction is too high and whether or not something would be lower, or whether, how do we define gross receipts? Because gross receipts currently defined my understanding, again, last I've seen, don't include program service revenue, and basically don't include investment income. But the program service revenue not be included, I think, for organizations that have a 50% reduction in gross receipts because they can't have their annual meeting, which is a big source of funds for them, would be, I think, leave out a segment of folks that may have a real need for a second round of funding and didn't get it. So looking at the eligible entities, it's been expanded. Certain nonprofits, veterans organizations, tribal businesses, self-employed, sole proprietors, independent contractors, small agricultural cooperatives. Now, interestingly here, that includes 501c6 organizations that we'll talk about in a second. There's been a big lobby since the PPP loans came out to include 501c6s. The Democrat side, I believe, includes any nonprofit, including C4s and C6s. There's a limit on C4s that about what political activity they can be doing during this upcoming election cycle that would limit it. But defining gross receipts, I think, is something they're struggling with, and how we would do it to make that measurable. Basically, it's 2.5 times the average monthly payroll costs for loans up to 2 million. And if you weren't in business, for the new businesses can do that, times the total number of months they were in business. The second draw would be eligible for loan forgiveness on the sum of their payroll costs, covered mortgage, utilities, operation expenditures, damage costs, as we talked about, all those other things incurred before January 1, 2021, and the 60/40 allocation would continue to apply. So let's talk on the next slide about the 501c6s and what that would do. So a 501c6 would be eligible if the organization does not receive more than 10% of its receipts from lobbying, and the lobbying activities do not comprise more than 10% of receipts, has 50 or fewer employees, and the covered loan is not more than 500,000. Would also include chambers of commerce that were C6s with 300 or fewer employees, and certain tourism bureaus or destination marketing organizations that are C6s, quasi-government or political subdivisions, state and local governments with 300 or fewer employees. So a couple of things here. I'm not really sure, based on what they've defined, when it says does not receive more than 10% of its receipts from lobbying, and does not, and lobbying activities do not comprise more than 10% of receipts. Couple of questions that come up there is, you know, are we looking at our dues notification? C6s usually have to notify about how much of the dues received go to lobbying, and some of those percentages may be increased or decreased because they have a carryover or an understatement of their previous years, and so we don't know how that impacts it. So there are a lot of questions that if it gets passed the way it is, that I think they'll have to give some more definition to. Couple of highlights about what the Democratic proposal is. They maintain the funding level, which was about $659 billion. The Republican proposal, as it stands, I believe, increased it to $749 billion. The Democrats' proposal expands eligibilities not only to nonprofits of any type or size, but also local news outlets. So they expand the potential borrower pool there, and have some set asides for additional smaller borrowers there. So on the Democrats, what we're going to get between the Democrats and Republicans, we can't really know for sure here. But the deadline is for Friday before they go on break. The prospects are anybody's guess at this point. So just to highlight you on some things to be aware of if we do get this legislation this week, there's going to be potentially an expanded borrower pool among the nonprofits. So, and with that, I'll turn it back to Troy, and we can see if we have questions or things that people would like to discuss further.
Thank you, Dick, Amy, and Eleanor for the great presentation today. Before we wrap up today, we want to answer a few of the questions that have been submitted during the webinar. If you have any additional questions after today's program, please reach out to us. Our contact information appears here. So let's get started on some of the questions that we've gotten. Let's see, the first one. Can the submission of PPP loan forgiveness application be earlier than 24 weeks, say 18 weeks? If so, what are the requirements for payroll documents? Dick, do you want to take that one?
Sure, I'll start out, and Eleanor and Amy can jump in as well. I think it's clear that you're not bound to if you don't choose the 8 weeks, you're not bound to wait till the 24 weeks is up. And I think most folks that I've talked to will have, through payroll costs, because it's calculated on 2.5 months, would have met the expenditure responsibility, the expenditure threshold for the 24 or for the payroll there. Now, what's clear so far is that if you do apply earlier than the end of the 24 months and you have reduced payroll by more than 25% for an employee, you don't cut that reduction off at the 18 weeks, for example. You would have to extrapolate that out to 24 weeks. What we think the answer is on the FTE reduction is you would calculate your FTE reduction as the date of the end of your covered period, if it's 12 weeks, 18 weeks, or whatever, and that presumably if you had layoffs at week 20 or 22, a reduction in FTE, that would not harm your forgiveness amount. But that's what we think the answer is now. We don't have anything clear on that. And as far as the documentation, I think Eleanor covered the required documentation. I think you would just show that for the period that you were asking for forgiveness there. And as I said, Eleanor, feel free to jump in with any additions if you have any other thoughts on that.
Yeah, the basic answer is that you could apply early within your 24-week period if you're done spending the funds. Just be cautious of what the impact is on your FTE and your wage reductions.
Great, thank you both. Let's see, we have another question that says, if we have a PPP loan, should we be submitting for loan forgiveness now? Assuming, I guess, that they're ready to do so, or wait until further guidance and clarity on the program. Amy, do you want to take that one?
Sure, I can take that one. I think that, in a couple places we stated that really right now it's probably best to wait just until we get this additional guidance to come out. And especially as Eleanor mentioned, right now the banks aren't even accepting it, or the SBA isn't accepting it. So maybe here in the next couple weeks we'll get that required information, and then you can still submit early. But I think right now I would be a little leery of trying to do it too quickly.
Okay. Let's see. Here's one. If a borrower got a loan in early May, planning to use the 8-week covered period, which ended before June 30, will they be affected by an FTE reduction for employees they laid off in early July? Eleanor, do you want to take that one?
Yeah, so if I understood correctly, the borrower chose the 8-week period, which ended sometime in June. And they met the FTE tests, and then they reduced them after their 8-week period in July. And that actually is fine. The PPP loan is protecting your employees during your covered period, but there's nothing currently to stop you from then going back to, unfortunately, reducing FTEs or laying off because you no longer have the funds. So in that situation where you've used all your funds and your covered period is over, it's fair game after that. The FTEs can once again be reduced.
Great, thank you. Let's see, another question. In terms of dates of getting the loan, is that when the document was signed or when the cash was received? Our two dates happen on either side of June 5th, of the June 5th date. So it says again, in terms of dates of getting the loan, is that when the document was signed, I guess the loan document was signed, or when the cash was received? Our two dates happen on either side of June 5th. Amy, do you want to take that one?
Sure. So I guess that is interesting that it happened right around the June 5th deadline, or the June 5th date of everything was changed a little bit. But I think if you look at the FAQs, they do discuss that the covered period starts the date your lender makes the disbursement. So I would think then that you would go on the date that you received that cash. So I think then you are past that June 5th date. So then you would apply, you would be under the new requirements.
Okay. Let's see, another question says here, I thought the 8-week period was an option if you received your loan in late June. Can you confirm this?
And I can take that one too, Troy. So the 8-week period is basically for those that received the PPP loan before the June 5th, before that CARES Act. Anything after the June 5th is under the 24-week period. So you have a choice to use 8 or 24 if you were prior to the June 5th date, but after the June 5th date, you're under the new guidelines of the 24 week.
Great, thank you. Let's see, another question. It says here, I had an FTE resign in July and a new FTE was hired to replace them in the beginning of August. Total time with reduced FTE was less than 2 weeks. Do I still qualify for the EZ application?
I could take that one. They actually do based just on the fact that the employee resigned. So their FTE reduction, even if it was only for 2 weeks, if it actually does reduce their weekly average based on how big they are, they could qualify for the EZ because they didn't have an FTE reduction that didn't fall under one of the exceptions. So I don't know what the rest of the situation is, but if that was the only FTE reduction, then the application does indicate that you could still qualify because you did have an FTE reduction, but you fell under one of the reasons that is acceptable and doesn't harm the loan forgiveness. So that should be fine.
Okay. Let's see. Another question. What happens if you file for forgiveness by our year end, which is 12/31, but we do not get an answer before year end? Then is a loan on our books over a year end, but how do we treat this for funders and double dipping? So I think it's, not sure I quite understand the entire question. But I guess it's based on your year end and whether or not you don't have forgiveness by the end of the year.
Right, Troy. I think what the question is trying to say is, so they're at year end, they've recorded the loan and they don't know if there is forgiveness yet or not. So they're worried that they didn't charge the funders for that because they don't want to double dip because they're saying those salaries are covered by PPP funding, but they're worried then after year end, what if some of that isn't forgiven? And then they hadn't charged the other funders for those salaries, what is the case there? And I mean, that's a tough question. I think it's a tough situation because you're not going to know that answer. I think you have to go under, looking at your documentation and the assumptions of if you think it's going to be forgiven or not. And the only other thing I can say is depending on how long, hopefully you have submitted for application and that you'll find shortly after year end and can determine that appropriately. But I think you have to go on the conservative route and basically not be charging those awards if you are anticipating forgiveness.
Okay, great, thank you. Let's see, another question, it's a short one. It says, how do I report an employee's salary above 100,000?
So on the full, you only need to report it if you're filing the full PPP application. On the EZ, there's no listing of employee wages, but if you look at the full application on Schedule A, there's one section for those that earn less than 100,000 annualized, and then it's Table 1. And then Table 2 is for some other individuals, including those that earned more than 100,000. And in Table 2, where you're reporting those employee earners with annualized wages of over 100,000, there's less to report because you're able to reduce their salaries. They're not, so to speak, covered under the PPP that's protecting those that earned under 100,000. So although you could include the wages for those earning over 100,000, they're just reported separately so that mathematically they don't impact the wage reduction if it impacts your loan. But the short answer to the short and great question is that it's on Table 2 of the Schedule A worksheet.
Okay, great. All right, we got time for a couple more here. Let's see, if an employee goes on maternity leave during the covered period, can that have an impact on the FTE reduction ratio?
I'm going to say that it doesn't, and Dick and Amy, let me know if you agree. It's not specifically covered, at least that I've seen in the FAQs or the guidance. But I would think that that falls under the exception where the employee reduced their hours or not resigned, but took leave for their own reasons. So it's not that the employer laid them off or forcefully reduced their hours because of COVID, declines in revenue. I would think that maternity leave is covered under those exceptions.
And I'm going to jump in. Oh, go ahead, Dick.
I would agree. I think there's some, I don't think the FAQ specifically mentioned that, but it does talk about salaries, wages, tips, vacation pay, parental and family leave. So I think in that case, that are all covered under payroll costs. So I think that maternity leave would fit that, but I haven't seen anything directly address that. And Amy, I'll hand it over to you.
Yeah, the only thing I was going to add is, because this does seem like a popular question, I would say that it wouldn't surprise me if the FAQs on forgiveness that were just released, if that doesn't come out in one of those. So I would say continue to monitor those.
Okay, great. Let's see, another question here. We got a PPP loan for $99K and we have utilized it completely in terms of payroll and rent. When can we apply for forgiveness, and will the lender let us know or send us the application for forgiveness? The information seems to be constantly changing. So can they apply now, and will the lender reach out to them, or should they be proactive, I guess?
It really depends on the bank. We do know that you can't apply now, even if you wanted to. So that's fine. And none of the lenders are able to submit to the SBA yet. If you're with a larger bank that has more resources in place, they'll probably have a formal portal. Maybe it's even an interactive version of the application where you fill it in directly in your bank login. And we've already seen a few of the larger banks that are sending out regular communications to the PPP loan recipients, giving them updates to the best of their knowledge. They also are at the whim of Congress and when the new guidance is going to come out, but they're sort of keeping their borrowers in touch and trying to give them updates on when the portals will go live. If you're at a smaller bank, this might just be your point person at the bank that reaches out, or you might have to reach out to them. So it really depends on your bank. But if you haven't heard from your bank until now with like a general email blast or something like that with an update on what's going on with PPP applications, reach out to your point person there just to see what's going on, how they're going to be handling the application submissions, whether it'll be an automated portal or you'll have to submit by email to an individual. Some of them might even have their checklists ready for, based on what they know now, what documentation they're going to collect, so you could start getting that ready. But in terms of whether they'll reach out, I would hope so, but I'm sure that some banks just won't.
Okay, thank you, Eleanor. This will be our last question because we're out of time. For a salary reduction, does it go by salary of the employee, for example, $20 per hour, or does it go by total salary paid? For example, if a person's hourly rate is not reduced, but their hours are reduced, salary paid is reduced, but not their rate. So basically just a cut in hours, but not hourly pay. How does that affect the calculation?
That one is going to be based on whether the individual got a pay cut. I'm actually not sure how you would reflect that on the PPP schedule that lists your employees out, because it just asks for total cash compensation. So it might look as if they got a salary reduction when really they just had an hour reduction. But I know that conceptually the answer is that their actual earnings stayed the same. Although if they did have an hour reduction, then it might impact you on the FTE level.
Okay, great. Well, that's a wrap for us today. Thank you to all the presenters for the presentation and answering all the questions. Again, if we didn't get to your question, please reach out to us. So with that, we would like to thank everyone for attending today's webinar. We encourage you to follow up on Follow us on social media at GRF CPAs and visit our website at www.grfcpa.com for upcoming events and alerts, including information on these 2 webinars that we'll be hosting later this month. Please remember to complete the email survey that follows if you would like to earn CPE credit for attending today's webinar. Thank you again for attending and have a great day.